Welcome to This Explainer. Today, we are taking JD.com and running it through an absolute valuation gauntlet. As an investment analyst, it's one thing to just glance at a stock's chart, but it's a completely different ballgame to stress test a company's financials using the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, alongside some rigorous modern discounted cash flow modeling. So, is this Chinese e-commerce giant a value trap, or could it be the ultimate hidden gem? Let's find out. Here's our roadmap for today. We're covering the JD.com snapshot, the Warren Buffett lens, the Peter Lynch lens, the Benjamin Graham lens, DCF and alternative valuations, and finally, a synthesis and final verdict. Let's get right into it. Section 1, the JD.com snapshot, e-commerce, supply chain, and Q1 2026 results. JD.com isn't just some website, it's a total powerhouse in the supply chain and e-commerce world. Just look at Q1 2026. They raked in a staggering 315.7 billion RMB in net revenues. That's up 4.9% year over year. I mean, they're moving some serious volume here. Looking under the hood, we've got a company right in the middle of a major transition. JD Retail is obviously their bread and butter, but product revenues are kind of slowing down, growing at just about 1%. But here's the kicker. Their high-margin service revenues, we're talking logistics and marketplace advertising, are absolutely surging by over 20%. This pivot helped them crank out a very solid 7.4 billion RMB in non-GAAP net income this past quarter. And right now, Wall Street analysts are pegging it with an average price target of $39.52. Moving on to Section 2, the Warren Buffett lens, moats, management, and owner earnings. So what does the Oracle of Omaha look for? He loves a wide moat, right? Well, JD's proprietary logistics network, which, by the way, is now promising double 11 speed delivery all the way in Europe, is a massive barrier to entry. Plus, the management team is super shareholder-friendly. They bought back $631 million in stock in just one quarter. Throw in a literal fortress of a balance sheet with 215.7 billion RMB in cash and short-term investments, totally dwarfing their 50.4 billion in total debt, and yeah, JD definitely checks Buffett's qualitative boxes. But the real holy grail for Buffett is owner earnings, the actual cold hard cash a business generates for the folks who own it. JD's trailing 12-month free cash flow is sitting at an enormous 21.6 billion RMB. That level of cash generation, that's the ultimate margin of safety Buffett demands before he even thinks about making an investment. Section 3, the Peter Lynch lens, categorization and the PEG ratio. Lynch would likely categorize JD as a stalwart that's actually finding a whole new gear as a fast grower thanks to its services division. And if you know Lynch, you know his ultimate metric is the PEG ratio, price to earnings divided by growth. When we compare an implied forward PE of around 18.4 against a massive 25.9% projected EPS growth for 2026, we get a PEG ratio of roughly 0.71. Anything under 1.0 is a screaming buy signal in Lynch's playbook. On top of that, Lynch was always hunting for companies that were actively shrinking their share count because it signals that management firmly believes their stock is undervalued. Just like CFO Ian Suchon called out, JD repurchased 1.6% of its entire outstanding shares in barely 3 months, all while paying out a solid annual dividend. Capital allocation like that, Lynch would absolutely eat that up. All right, Section 4, the Benjamin Graham lens, the defensive investor checklist, and intrinsic value. Graham is famously strict. He demands an incredibly strong financial condition. Well, JD has current assets of 364.6 billion RMB, which easily wipes out its current liabilities of 309 billion. This is exactly the kind of rock-solid liquidity buffer the father of value investing is searching for. When we run JD through Graham's famously rigorous defensive investor checklist, the results are actually kind of remarkable. Adequate size? Pass. They have frankly gigantic revenue. Strong financial condition? Pass. Record operating profit stability in retail? Pass. A proven dividend record? Pass. It surprisingly clears every single conservative hurdle, which, let's be honest, is incredibly rare for a modern tech retail hybrid. Now, the math here is super interesting. Graham popularized a very specific formula to estimate intrinsic value. You take the square root of 22.5 times earnings per share times book value per share. So if we plug in our estimated forward 2026 EPS of about $3.50 and a book value of around $22 per ADS, Graham's formula spits out an intrinsic value of roughly $41.60 per ADS. What does that mean for us? It tells us that even if you use the absolute most stringent asset and earnings-based historical metrics out there, JD.com has a very clear built-in margin of safety at its current trading levels. Section 5, DCF and Alternative Valuations. Forecasting future cash flows. Let's build out a base case discounted cash flow model. We'll start with their actual trailing 12-month free cash flow of 21.6 billion RMB. Now, if we forecast that out 5 years, apply a standard weighted average cost of capital, our discount rate, of 10%, and assume a super modest perpetual terminal growth rate of just 2%, we get some pretty fascinating numbers. If we run a sensitivity analysis right in the middle, a 10% WACC and a 2% growth rate lands us at a $39.50 fair value. Essentially, unless JD's cost of capital spikes all the way up to 11% or their growth completely flatlines, the calculated fair value per share comfortably exceeds where the stock has been trading. And just to cross-check our DCF, let's run 2 alternative valuation models. If we use a comparable company analysis with an EV to EBITDA multiple of 8x, we get a fair value range right around $42. Meanwhile, a super conservative dividend discount model factoring in those recent payouts gives us a floor value of roughly $36. Notice how both of those models align really tightly with the Wall Street consensus average of $39.52. Finally, Section 6, Synthesis and Final Verdict. Bringing the gauntlet together. Let's bring it all together for a final scorecard. Across the board, from Graham's highly defensive deep value, to Lynch's growth at a reasonable price PEG ratio, to Buffett's obsession with free cash flow, right down to modern DCF and comparable multiple targets, JD.com triggers a unified buy signal. I've got to say, it is remarkably rare for one single stock to satisfy all these totally distinct frameworks at the exact same time. But as objective analysts, we've got to call out the risks. You have to weigh their absolute powerhouse logistics network and surging service revenues against that sluggish 1% growth in core product retail. Plus, you've got to factor in the heavy capital investments they're sinking into new businesses like Joybuy in Europe and JD Food Delivery, which, for now, are dragging down overall group operating margins to about 1.2%. Even with those risks, blending all these insights together, JD.com is fundamentally a buy. The balance sheet is just too robust, and the cash flow is too heavy to ignore. The ideal trigger price? Snapping up shares on any dip below $35 perfectly maximizes your margin of safety across Buffett's, Lynch's, and Graham's models. I'll leave you with this to ponder. When the historical legends of value investing, aggressive growth frameworks, and cold, hard, quantitative DCF models all scream the exact same thing, are you going to trust the data or the market noise? Sometimes the only missing ingredient to massive returns is patience. Thanks for joining me for this explainer.